Welcome to Jay's Corner. Today's guest is Ann Lester, and let me just say, it gets no better than today. I spend a lot of time trying to simplify finance and personal finance into language that everyday people can understand. That should never be confused with the idea that it's actually simple. Ann has been on the playing field at JP Morgan as the head of retirement solutions. We're going to talk about targeted date funds, which sit in the majority, if not virtually every large employer 401k plan. We'll talk about the objectives. I'll have tons of questions for her. I'm going to try to keep it as brief and as simple as possible. Look forward to this. I can't tell you how excited I am to have Ann join us here on Jay's Corner. Hope you like it. We welcome Ann Lester, and to be candid with you, I could read all of her qualifications and discuss all of her accomplishments over her career. It would take the entire broadcast. But let's just say that Ann has been the head of retirement services at JP Morgan. That puts her pretty much directly on the playing field. Ann, welcome here. Thank you so much for joining.
Oh, Jay, thank you. It's my pleasure to be here.
So we first met in May, face to face anyway, although we've been on conference calls together at the Alliance for Lifetime Income. It was a summit for lifetime protected income. Fascinating summit. I'm not sure what you found. I would love to hear what your takeaways were from that summit.
Well, I think the work that the Alliance is doing is terrific because I think, when you talk about how to translate your retirement savings into income and to live off of it, it's so difficult for people because they, have spent all this time saving, and, don't touch it. And then suddenly it's like, okay, now you're supposed to touch it. And it's just really hard to do. And I think most people underestimate the power that a guaranteed stream of income will have, especially when it's going to last your whole life, in giving you permission to spend your money. And that's something we did a lot of research on when I was at JP Morgan, heading up retirement solutions there, and trying to understand what goes on in people's brains when they have to flip into spenders from savers. It's a really big identity crisis. So I think the Alliance is doing terrific work in general. From the summit specifically, I thought there was some terrific work done sharing the findings from personas, having a lot of sort of sessions with, I'm going to call it real life people, talking about their own challenges and their own journeys on how to manage that flip into spending. And then I thought the panel I was on was really interesting. Of course, I thought it was interesting, but I really enjoyed it because it was talking about kind of where the rubber meets the road inside of the 401k system and the possibility of having more lifetime income options inside of a 401k plan. And again, that's something, theoretically, I'm a former target date fund manager, don't take my money away from me. But I've always, even, back in the 2000s, when we started the target date funds in 2005, thought that it would be very appropriate for people to, frankly, annuitize, that's the other word we use, but to take some of that money and put it into a lifetime income stream, to me, always made a lot of sense.
And you're right, from the playing field, as I stated. So you've been dealing with trying to educate, the HR departments of large companies when even bringing them up to speed on targeted date funds. And I think that has probably been one of your biggest challenges, if I had to guess.
It's been a fascinating 2 decades now, right? So target date funds have been around now for about 25 years in this country. They started overseas even earlier, but they really took off in the sort of early 2000s. And the Pension Protection Act, which is a law that was passed in 2006, really created a lot of incentives for HR departments and for plan sponsors, right? The companies, to use target date funds, and then to do something which is now very commonplace, but 20 years ago was considered a little out there, which is to default people into target date funds, which is why they're so popular right now. But at the very beginning, just helping HR departments understand, and plan sponsors understand, how difficult it is for people to make decisions about their own money. It is existentially frightening for most people to try to solve the how do I invest my money when you don't know how long you're going to live, you don't know how much you're going to be able to save, you don't know what the markets will do, and you don't know when you're going to die. So there are all these unknown things out there. And so trying to make decisions around how much to save, how to invest that money, I think is very challenging for most people. It's challenging intellectually, and it's also challenging emotionally. And so I think one of the greatest gifts that target date funds have given the whole sort of retirement savings ecosystem, if you will, is helping to take some of the decision-making burden away from individual savers, and also help them not go in there and check their balance all the time, which is,
For
a really
sure.
bad thing to do when the markets are going down. So, we've seen much less destructive behavior the last two market downturns we've had, with COVID and with the recession. Both of those incidents triggered much less sort of panic selling than we've seen recently in the 401k system compared to, let's say, 2001 or even the financial crisis in 2008. So I think, the benefits are multiple for target date funds in general. And so the question is, how can we make them sort of better, and the whole 401k system better fit for purpose as people move into retirement and as more and more baby boomers retire?
If we go back to that 20 years ago when you were first proposing this platform, and let's just call it a platform because
Yep.
JP Morgan certainly won, and then of course it's a copycat world, so you've got all of your competitors at that point in time. Explain to us how you educated all the departments in terms of, why did they know already the benefits of diversification, how you were building these products for them?
I think it was a real journey, and I'd say it's one that the industry in general and my former employer, JP Morgan, is still on, which is, and it's funny because I had to walk that same path that we were taking companies and employers on, which is the first trick was, is it okay for me to tell somebody else how to invest their money? Right? Because that's what a default is. And a target date fund says, yeah, I know what the right answer is for you. And, let's be honest, I don't, because I don't know what your specific facts and circumstances are. So it's incredibly, it's a very humbling experience to say, actually, I do know what the right answer is for you. And so I think the point of departure for me intellectually wasn't, I have to get the right answer for you, Jay, or anybody. The point of departure is, can I do a better job at determining a pretty good answer for you than you would do by yourself? Which is a really different level of success, right? That's a different standard I'm holding myself to. It isn't perfection. And I guess the other very humbling thing any investor has to come to terms with, and certainly a target date investor, is there is no such thing as perfection, because we don't know what the markets will do. We don't know how much you're going to save. We don't know when you're going to die. So perfection is off the table. The question is, can we do a better job than you probably would left to your own devices? And so the standard sort of, I don't know what I'm doing, or default options at the time in let's say 2003, 2004, were either cash, a balanced fund,
right,
or letting the individual pick their own things. And I can assure you that a target date fund is going to do a better job over the long term, not necessarily in any individual year, but certainly over a rolling 3, 5, 7, 10-year period. A target date fund is going to do a better job than probably any of those things, right? Because a balanced fund, a 50-50, 60-40 stock bond portfolio, is probably not generating enough returns for the 20, 30, and 40-year-olds, and maybe a little too risky for somebody in their 60s. So you want to get the right mix. And then I think we can all agree that cash and even stable value is just not going to generate the long-term returns that is most appropriate for someone who's saving for 30 or 40 years.
When you were going through that process, I guess where I'm going here is, how many hurdles did you encounter when all of the information actually in the press, the media, it's glamorous to pick a stock. It's,
yeah,
you got line item attention.
So
but
I got
you're building a portfolio.
so the people forget, but the financial markets were kind of ugly in 2000, 2001, 2002, right? There was a big sell-off in the equity market, and I think that was the first time in almost 20 years that it stopped being fun to pick investments, right? You came out of the dot-com boom when everybody wanted to pick investments, and when you had this wide proliferation of options inside of 401k plans, because people wanted the small cap value fund, and they wanted the Zambian gold mine fund, and they wanted the this and the that, and it was fun. And I think it's a combination of that big pullback in the markets being not fun, and the ability for data processing, right? We forget how important measuring and presenting information is, but something else that radically changed in the early 2000s was computing power, thanks to that dot-com thing and the big burst in computing technology, and the ability to say, this is the scatter plot of how your participants, how your employees are actually doing in their 401k plans. Before that, it was very common for an employer to look at how each fund was doing. And I've got X amount of money in this fund. This fund is doing XYZ. I'm doing a good job. And nobody was stopping and asking the question, the funds may be doing fine, but how is the employee doing investing in the funds? Because that's what counts, right? Like, I don't care how good the funds are. If your employees are basically day trading their 401k plan, and a lot of people were doing that, right? We know now, because we can measure it and we can monitor it, that a lot of people were buying when it felt good and selling when it felt bad. And it feels good when it's going up, and it feels bad when it's going down. And so when you're doing that, you are buying high and selling low, which destroys wealth. And so we were seeing, when we were suddenly able to measure how well people were doing, to see these enormous gaps between the average performance in the funds that were there and what employees were actually getting. And that's because they were destroying value by trading inappropriately. We were also able to do scatter plots of what their asset allocation was, right? The mix of stocks and bonds. And we saw basically solid lines, right? 100% stocks and 0 and 100% cash, and relatively few people with what I would, or most professional investors would say, was an appropriate mix of stocks and bonds, especially for their age. And so just showing people this data was important. And then at the same time, right, you had Nobel Prizes being awarded for behavioral economics. And all of that came together in the sort of early 2000s to say, look, we know now that giving people choices makes them stupid. Too many choices. I shouldn't say one choice or 3 choices or 5 choices, but 200 choices, right, is overwhelming. And, there's I love this really famous study of people in stores trying to buy jam. And the more, if you ask somebody, do you want to have choice? Do you want to have lots of flavors? Do you want to have lots of different brands and kinds and flavors of jam? Everybody goes, of course, more choice is good. I want more choice. But when you look at how well they can make a decision and how they feel about that decision, once you get past 8 or 9 choices, it starts going down. And when you get too many choices, people just shut down and don't make a decision at all and leave. And they don't even buy any jam, because they just go, oh my gosh, I don't even know if I want strawberry rhubarb or 4 berry or, no sugar added, or, like, forget it, I'm out of here. So we've learned a lot about both how the brain works when it's confronted with making decisions, and how sensible it is for people who have neither one of the time, talent, or interest to educate themselves robustly on investing. Most people don't think it's fun, right? They'd rather go do the dishes than pick a fund lineup.
I wouldn't go as far as saying doing the dishes, but yes.
That's how I felt. I mean, I remember trying to sign up for the 401k plan when we moved back to the US. I started my career with JP Morgan in Italy, and we moved back, and, we were having a baby and had just bought a house. And I remember going online and trying to figure out if I'd was saving enough. And I remember going into the online interface from home and, on the dial-up connection.
Right.
And I remember starting to fill in this questionnaire, and it was a lot. We know a lot more today about user interface and good design, right, than we did back then. But I still remember one of the
Absolutely.
questions being, what do I think the inflation rate is going to be between now and when I retire? Now I was just like, I'm out.
Right.
Like, I literally was just like, I'm out. I'm done. I can't do this. And I thought, I literally am a professional investor. I have a master's degree in economics. I'm a bond trader,
Right.
and I'm done. Like, I can't, what? Like, what? So anyway, we don't ask people that question anymore, but it's really intimidating. And I think the financial services industry in general, and this loops back into the work the Alliance is doing, right? I think the financial services industry in general is full of people like us who think this stuff is really cool. And maybe
Right.
a lot of the listeners to this podcast, right, think this stuff is cool. They want to learn more. They want to be educated. And that's terrific. And I'm so happy that there are so many great resources out there for people, like you, who are interested in learning more. But, let's be honest, maybe 50, 60, 70% of the people out there just want the whole thing to go away. And so I think target date funds are a product that is a terrific answer for the people who just don't want to engage.
And for those persons, why don't we just give them the, high level overview? So we
What's a
get
target date fund?
you've got this menu at
Right.
almost every 401k plan, where you've got even amongst targeted date funds, you've got these different dates. But let's
Yeah.
just start with the basic structure.
Yep.
Just have
So
one targeted date fund.
yeah. So again, every 401k plan is different. So,
Mhm.
your mileage will definitely vary, but
Sure.
basically the architecture that I think makes a lot of sense, and I think a lot of plans have now, is sort of a do it for me, do it with me, I'll do it all by myself kind of structure. So the do it for me is a target date fund. And when
Sure.
you probably now, if you've been hired in the last 3 to 5 years, it's very likely that you've been defaulted into a target date fund. And that target date fund corresponds, the number on the target date fund, let's say 2030, would
Sure.
correspond when the date when you're going to be around 65. And that's pretty conventional. One could argue that it should be 67 because that's now the maximum, the minute sort of
Full
full
retirement
retirement age. But,
Sure.
bottom line, that's getting kind of fancy, and really 65, 67, it's probably in the right zone for you. And so, if you're 59, let's say, hypothetically speaking, you should be in the 2030 target date fund, right? Because, you'll be sort of 66 when you retire at
Right.
that
In that
point, if I'm
in that
doing my
time
math, right?
zone,
So
in that
that's
time
about
range.
right. Speaking in terms of the target date fund I'm in, even though I'm already retired, I still have my money in the JP Morgan plan, and it's all still in that target date fund. All my 401k money. So that is like the bottom line for these plans. If you are choosing a target date fund, or if you want to think about if that number is right for me, there are two ways
Right.
to think about that. One, am I going to retire earlier or later and not need the money, or need it earlier? In which case you might move yourself into, 5 years longer, 5 years shorter. The second way to think about that is, am I comfortable with the level of risk that target date fund is taking for me? That's a little more sophisticated.
I think, right. I think that those are two like awesome points, because the exactly what you stated, which is, and it kind of comes back to, and I asked you about the summit. For me,
Yeah.
the takeaway was actually that, which was glossed over in a way, that during the luncheon there was Professor Bernarzi who was
Yes.
speaking, and what he noted was that if you ask a population of people, that they gave themselves a health index, and that health index changed actually their mortality or their life expectancy by something like 5 to 7 years.
Yep.
5 to 7 years changes the weighted average life of a portfolio, for example. You see what I'm saying? The duration
Absolutely.
risk, you're a bond trader, as am I. So I mean, you were talking about, your duration risks, et cetera, are all now different. And so especially your second point, which is, and just if you would touch on that, which is you really have a menu of different dates.
Right.
So how do these different funds, why don't you tell the audience,
Yep.
explain to them what is different inside
Yep.
the funds in
Each
these
fund.
different
Yeah.
dates? Sure.
So all target date funds share a basic similar characteristic, right? Which is that when you're young, and that would be the 2060, or I think there are 2070 funds out there now, though that blows my mind. But when you're young, let's say you're 25, you're 30, right? You'd be buying that 2060 or 2070 fund, whatever the math works out to be, because that's when you'll be 65. So my son, who was born in 1999, should buy the 2065 fund because that's when he'll be 65. When he buys that 2065 fund today, it's going to have probably 90% equity in there. Not 100%, because the Department of Labor says that a suitable target date fund should have a mix of some stocks and some bonds. So zero stocks is like not okay by regulation. So, and I would argue as a portfolio manager, like a little bit of bond diversification is always good, no matter how long an investment horizon you have. So let's call it 90% stocks, 85, whatever it is. Most target date funds keep that allocation at that high level of stocks until the participant, right? The like my son, who let's just round and say was born in 2000 because it makes the math.
Sure. Easy.
So when he's 40 years old in 2040, right? That 2065 fund, which now has 25 years left, will probably start or around there, right? Like I said, every manager is different. You can find it on the website of your 401k plan.
All the different.
All of the differences, but it'll have specific information. But most target date funds start what's called de-risking somewhere between 40 and 35 and 50, depending on the company. And what that means, the de-risking, is that you gradually move out of stocks into bonds. So as you age, your portfolio will be taking less and less risk. And the reason for that is, of course, when you have lots and lots of stocks and you retire, the thinking goes, you will probably take some or all of that money out of the 401k plan. And when you cash out, when you sell and the market's down, or even if you're just taking a little bit out, right? If it's very heavily weighted in stocks, let's say 60, 70, 80%, and the market does what it did a year or two ago and is down 40%, you are really, really damaging the chance that that money will last until you retire. Because when you sell after a big drop, even though in a couple of years it'll go back up, it always has, it always will, I firmly believe that, you will have taken enough of the principal away that you'll never recover back to where you were because you've sold some of the assets. So you've sold at the bottom, you've realized those losses. And so most target date funds start de-risking in people's 40s, which is when, and this was a big part of the JP Morgan target date philosophy. That's when we noticed that the biggest withdrawals started happening, with lump sum withdrawals, with people rolling out and cashing out a little bit because life, kids are getting older, college tuitions, accidents, stuff starts happening.
Sure, absolutely.
But as you approach retirement, then the other big difference that target date funds have is how much risk they have when you're in your 60s. It can be as high as, if I remember correctly, 50 or 60%, and as low as 20% at the age of 65, for instance. So there you start seeing these really big differences in target date funds emerging when you're in your sort of later 50s and 60s. And then some target date funds continue becoming less risky as you age, if you hold it into your 70s, for instance. Others maintain a constant level of risk. So, I would say if you're younger, in your 20s and 30s, there's probably not much difference in the year that you're in, because you've got that flat glide path. But as you get into your probably 40s and 50s, as your financial life gets more complex, you might have outside assets, you might have an inheritance, you might, spouses, right? That's when it really makes sense to start thinking, does this risk level make sense? Again, if you're the kind of person that thinks investigating this is fun, which I do. If you're not thinking that this sounds like a lot of fun, then you know what, it's probably just fun. I wouldn't get too worried about it. But if you really want to get in there and tinker, you can look at that level of risk and, do some math, educate yourself on, is, let's say, 50% what you want. If you want a little more risk, if you want 60%, let's just say you've got my husband's family's genes, his grandmother died at 106 and his mother at
Oh
91
my.
is flying around the world by herself, right? So if you're them, you maybe want a little more risk because you're going to live a long time. If you're somebody else and either personally know you're in less robust health, or you have a whole bunch of family conditions, it may be less likely that you will want that money to last that long, or that you'll need to draw on it earlier. You might want to be a little more conservative, and that would mean getting a target date fund that was maybe 5 years earlier.
And that's a very interesting point, and kind of one of the things that I wanted to get to, which is that you pointed out there's a base case, and then that glide path. The different firms have different definitions, which will differ, but not enormously, right? It's not like everyone has different mortality predictions, et cetera, to change that glide path. But if we even think about, if we peel one extra layer, you're sitting there, Anne, in her old seat, right? And you're seeing what's the mix supposed to be. Of course, for persons that don't even know. Persons don't even know, it's kind of stunning that people don't realize that, portfolio allocation becomes your number one determinant. And then but I want to actually talk to Anne about this, which is the guts, the innards, complicated stuff, Nobel Prizes on it, modern portfolio theory, clearly. What did Anne actually do? Got this inputs, you've got earnings estimates, you've got all sorts of different inputs into what Anne's decisions were on a particular fund, whether that be a 2050 targeted date fund, et cetera, et cetera. Why don't you give some insight in terms of what you actually looked at?
So this will get really geeky, but
Sure.
I think, I'll just say it again, I think anybody's target date fund is going to do a pretty good job. Even the ones that in my former role, I used to go, we're so much better than they are. Any of them are going to do a decent job. Like I said, I would argue some better than others, and that is evident in the performance. Fees are obviously a major driver of that. But I think, when we were looking at it, we started with a couple of different sort of high level, almost philosophical ideas. And I think, one underpinning of the approach that JP Morgan had and has today is that diversification is good. And I used to oversimplify it and I'd say this in pitches to big clients, like, more stuff is good, like, you want stuff. And what's the stuff, right? I think it's, back in 2000, right, when we were starting to think about these things and build out portfolios, I kid you not, high yield debt was exotic. Emerging markets equity and emerging market debts were exotic, right? So for us as institutional investors, and most target date funds were originally, the big ones started out of what I'm going to call a retail mutual fund type environment, where those products and that expertise wasn't typically in high demand. So one of the ways JP Morgan consciously differentiated itself, but it was because we'd been running institutional portfolios for very large defined benefit plans, which were very sophisticated, was to consider, starting with things like high yield, emerging market debt, emerging market equity, and things that retail investors can't buy, like direct property funds. I would argue today that should also include infrastructure. It should include private credit, which is like private equity, debt and equity that's issued by companies that aren't publicly traded, and retail investors just can't buy that. And I think I'm on the board of a company that does that. So I will say that in the full disclosure that I am on the board of a company that does that, but I joined that board because I believe that that really should have a role in more portfolios, because that's where the returns are. So at JP Morgan, right, we accessed everything we possibly could, including private credit and private real estate, when we launched those funds back in the sort of mid 2000s. So that was very exotic stuff. So number one hypothesis, more stuff is good. Number two hypothesis that we had was, if you think about the way you can design a multi-asset portfolio, right, a balanced fund, you can either try to maximize the amount of money you can have, which would put you on the aggressive end of portfolios,
Yep.
you could minimize the amount of money that people can lose,
Right.
which puts you on the conservative end. And as a philosophy, if you're building a glide path that is supposed to last for 40 or 50 or 60 years as individuals are investing, we philosophically decided that we were going to take the approach that minimized the number of individual outcomes that fell short of what we called the finish line. So we thought about this and we thought, what's the finish line? The finish line is when you combine Social Security and what you can get from your target date investments. We want to look at replacing 80%, 75, 80, I forget the exact number. We took it out of an Aon study, but somewhere between 75 and 80% of someone's pre-retirement income. So that's the model that we used when we started testing different glide paths, right? Do we want 60% stocks, 58% stocks? And inside of that, do we want large cap, small cap, emerging markets, international, developed, yada, 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 right? So lots and lots and lots of testing. And then the last thing that we did that was really, really different and really groundbreaking, that I'm tremendously proud of, and JP Morgan is still doing, is instead of just assuming that people saved 10% of their paycheck every year and left the money alone, just show of hands in the audience, how many people are saving 10% and leave it alone? Like nobody does that. Or, I mean, maybe these listeners do because, they're engaged and understand how important it is. But when you look at the statistics, most people don't save as much as, those of us in the profession think they should. And that savings isn't very constant or persistent. It goes up and down as people's wages change. As things happen to people, they bump up their contributions and lower them. I did that a few times in my 30s and 40s when we were, paying for nursery school and, all these things, right? It's like, oh, I can't make that contribution this year. I better nudge it down, right? So people's contributions aren't steady, but there's also a lot of what the industry calls leakage. And leakage is money leaving the plan. And that happens when you change jobs and you're like, yeah, I'm not going to roll that over. It's only $5,000. I'll just take it and pay the taxes on it, right? Don't do that. Bad thing. Don't do it. Another way money leaks out is people take loans out. I've done that. It's not great for long-term success because you've got to pay back the loan. And most people stop making contributions while they're paying that loan back, either because the plan forbids them to, or because they can't afford it. So you're missing contributions, you're missing the returns on that money. And then last but not least, a lot of people start taking significant sums out of their 401k plan when they turn 59 and a half, and the additional 10% penalty for early withdrawal goes away. And when you add all of that money, that up, what JP Morgan concluded was that given that volatility of cash flow intersecting with portfolios that go up and down, they trend up over time, but at any moment in time, it might be up or down. A slightly more defensive positioning of the equity risk in the portfolio was appropriate. So the conclusion JP Morgan drew, both because of this philosophy of wanting to maximize the number of individuals who hit a minimum level of income replacement, right? So you're trying to get more people over the finish line. The more risk you take, if this is the finish line, right? What we were trying to do is, and this is like the range of outcomes, we were trying to get the range of outcomes here. Yeah. If you take more risk, you widen the range of outcomes, but more people fall further below if they happen to pull their money out, last year when the market was down, because guess what? They retired and they needed the money, or their kid was getting married, or they had to buy a new roof, or like name the problem, right? People don't generally, when they need money and it's sitting in their 401k plan, their spouse loses a job, they're going to get their house foreclosed on. We saw so much.
Life happens, right?
Life happens, right? So, but that's a philosophy that your plan sponsor hopefully has thought about as an individual in a 401k plan, right? Well, JP Morgan would advocate they should think about. Sometimes they do, sometimes they don't. But as an individual in a 401k plan, you've got a choice, which is a target date fund. And I would argue it's probably going to do a better job than you might, and certainly than most of the people who work in your company. And there's lots and lots of statistics sort of proving that, comparing what people invested in target date funds get as a return compared to people who are trying to do it by themselves.
You mentioned that there was like three camps, kind of one, they don't do all in one, which is
Right. Do it
targeted
for
date fund.
me, do it with
Yeah.
me, do it by myself. Right. So the do it with me is what we would typically call the core menu, right? And so they're typically between 4 and 8 today funds in that core menu, maybe as many as 12 or 20. And again, the industry used to think more was better. So once upon a time, you'd find 40 or 50 funds
40,
in that core menu.
right, right.
And we realized as an industry that that just either told people it was a good idea to day trade, or you found people doing what we called the 1/n. Oh, they told me diversification, so I'll just put, if I have 20 funds, I'll put 5% in all of them. And it's like, no, that's not really right.
Yeah.
So nowadays, typically you've got almost certainly an S&P index fund, sometimes an active equity fund, either a blend, which is both growth and value, or sometimes growth and value, depending on the plan, depending how big it is, depending on what the employees want, depending on where they came from. Almost always a small cap fund, again, sometimes passive and active, sometimes just passive. It really depends on the employer. You'll find fixed income funds in there, typically one that represents sort of the standard, what we used to call the Lehman Ag, which is now the
Right. I still call it the Lehman. I still call it the
anyway,
Lehman Ag.
most it could be ag, we'll call it, which stands for aggregate, which is intended to capture the broadest sort of exposure to the
fixed
sort
income
of
markets,
non-high yield market.
Right. There you go.
You'll have an international stock fund. Sometimes that will be active, sometimes passive. Sometimes that will include emerging markets, sometimes it won't. Sometimes you'll find an emerging market equity fund that's a little more unusual. Sometimes you'll find a REIT fund or a real estate investment trust fund that's a little more unusual. So you have what sort of many or most of the building blocks of what a target date fund manager would use are often available in the plan.
And that's my question, which is that, if I could interrupt here, which is, you've got a targeted date fund, we've got professionals, the ANs of the world, ANs competitors, who are, will have their nuanced differences. They'll have different thoughts on earnings projections and, different types of allocations, which is too deep in the weeds. But really my question is, you're an everyday person contributing to the 401k, it's getting its match. You've got a default position. If you have a default position, why would you add extra sprinkles? You see what I'm saying? In other words, is the target date fund supposed to replace? Shouldn't it be replacing everything? And today's not financial advice, never is. But do you see where I'm going?
It should be. Yeah, no, I totally do. Well, let's just put it this way. When my husband was employed by a company with a 401k plan, he's in a very small company now that doesn't have one, unfortunately. But I was just like, leave it in the target date fund and don't do anything else. And he's like, yeah, but it's your competitor that you says sucks. And I'm like, I don't care, just leave it alone. It's going to be better than either of us dipping in and trying to fix it. And I'll tell you why, because to fix it requires maintenance and oversight and process. And if you don't have a process of going in there every 6 months, every year, rebalancing, if you're not going to be doing that in a disciplined way, if your plan sponsor happens to have, I don't know, a small cap growth fund, and if you're really in love with it's kind of having a flutter, like putting 5% on red, but I really, unless you have a very strong level of conviction and are passionately investing and are like really paying attention and have a process for rebalancing and reevaluating, I'd say that it could work out and be brilliant. It could be a terrible idea. I don't know. Nobody knows. But to me, if you don't have a process and a way of holding yourself accountable and a really specific reason why, like hypothetically, your spouse owns a small business and, there's some very particular circumstances around your financial situation, and your spouse or your other money is anchored either in really, really risky stuff or really, really conservative stuff, it might make sense to take that into account. Like, think about your household wealth, or if you personally, have other assets outside the 401k plan that are really extremely invested, maybe, to me, another way of doing it is just picking a different target date fund, right? But if you've got nothing but equity outside your 401k plan, maybe you should have some fixed income instead in your 401k plan, or vice versa, right? So I think, but that's a pretty limited set of people that are going to
Yeah,
have
that
those
is a
unique
limit.
situations, right? So I guess the other exception to some of this standard advice, and I remember working on some of these plans when I was back at JP Morgan, was if you're a first responder and are going to have several careers, like a lot of first responders stay, whether they're in the US military, police, fire, right? They'll stay, they'll get their pension, and then they'll go and have a second career.
Mhm.
If they have access to the federal thrift savings plan or
Sure.
some other kind of sort of defined contribution savings program, the dynamics there are different because you're going to get that pension, which is
Right.
basically fixed income.
Yep.
On the one hand, you can afford to take more risk and maybe should have some more equity. On the other hand, if you don't know you're going to get another job, you might not want to take more risk because you really need to count on that money, right? So that to me is a little more complex. And I don't think we're giving financial advice on this program, but that's where
Sure.
a chat with a financial planner could be helpful.
You had mentioned, we don't control where markets go and things like that, but what we did see kind of, and I mentioned this to you actually just in passing in May. I didn't want to go too far down the wormhole, but that the end of 2021 or the beginning of 2021 and the end of that first quarter was a very peculiar time for me, my observance of markets, meaning that what you had was meme stocks. We had a huge hedge fund blow up involved in TMT stocks, telecom media stocks. And we saw a bunch of dislocation at the same time. The Federal Reserve was clearly saying, look, my foot's going on the gas. It's going to stay on the gas. That would have reasonably changed the inputs to, now geeky, right? That would have changed not only your expected returns on your portfolio, your grid of returns and standard deviations of those asset classes, but also the correlations fairly dramatically. And this is, and actually what you wouldn't have known before we knew each other, and that in 2021, I was actually during August, I'm not sure if you remember, there was Hurricane Henri. And during that time, I was like, look, in March, I was pointing this out to you that the correlations here are screwed up, and they're screwed up in a way that I've not seen in a decade. And literally, and in other words, and we're pretty deep in the weeds here, right? So that I've called this to explain this to everyday people as the glue, right? Meaning you've got your small caps are going to get X, large cap Y, fixed income for diversification, etc. But as you know, that when you have high duress, all the correlations snap to one.
Yep.
And all of a sudden your benefits of diversification go away.
Yep.
What happens at the target? So now I'm asking, what happened at that time? Anne had her hat on.
Well, I didn't actually. Thank goodness I was out.
Right.
My problem. So it's a really interesting question, right? When things go bad, when things go wrong, correlations go to one. So I'll say in the financial crisis, right, in 2008, 2009,
sure,
correlations in the equity market went to one. The fixed income market did exactly what we hoped it would because the Fed was cutting, right? So the bonds had a great run and were very diversifying, as was real estate, despite the fact that it was kind of the cause of the whole thing, right? Commercial property that could be owned was a lot more stable. Unlike this most recent, call it correction, drawdown, bear market, whatever we want to call it, where everything correlated, including fixed income. And it's the first time in 30 years, right, that we'd seen sort of significant persistent. I mean, there was a little rate increase back, in 2000, whatever it was, in 1990s,
19,
95,
right.
whatever. Yeah. Okay. But Oh, and then like a flirting with it in 1819, but that didn't really
Flirting is
count.
a good way to say it.
But the last sustained, it was right when I was a new fixed income manager, right in the mid 90s, we saw rates go up and down. Because I remember suddenly getting interest in my savings account going, whoa, that's new. So here's the thing though, you got to distinguish between what again, at JP Morgan, we would think about as long-term capital market assumptions, which is every year based on where we see inflation, where we see interest rates, where we see earnings potential in companies because of big macro trends, right? Not looking at what's going to happen next year or in 2 years or in 5 years, but looking through 1 or 2 economic cycles. What do we think risk and return is going to look like? And we're not trying to get next month or next year, right? We're trying to say if we look out, what's going to, I don't want to make this sound like a commercial for JP Morgan, but obviously I was very invested in that process and I think it's a very, very good one. So that long-term anchor, which gets published every year in sort of September, October for the following year, huge 6-month project, a dozen people around the firm thinking big thoughts about this stuff. And the thing I always used to say to clients, and that I know myself, is that it's always going to be wrong, right? The number is never, stocks will return 6.9%, 7.2%,
Right.
whatever, the number is going to be wrong. What you want to be is directionally right with the relative return of different asset classes. Will US stocks continue to outperform international stocks over the next 10 years? And you want to be directionally right with both the level of risk and the relationship of risk. And if you can get that right over 10 years, and your clients are patient enough to look at rolling 10-year returns, I think that works extraordinarily well. And you can, as my former team has done, go back and look at how did those 10-year returns work out, and guess what, they worked out pretty well. So with the humility of knowing the number is never going to be right, you kind of say, I'm going to hold my breath and then you keep asking yourself, has something changed? Have I missed something? Is the fact that China seems to be in a different regulatory regime, let's call it that, than it might have been 5 years ago, changing anything about the way, so you have to ask, is inflation, temporary or persistent? Like, you have to keep asking, did I get that long-term call wrong? If you did, then you go, whoa, I better fix something. But if you didn't, and you can say, look, I really think this is part of this smaller cycle, then you say, okay, I'm leaving my long-term asset allocation alone. Then question, do you as a target date manager or an investment team have the confidence in your skill to make short-term, what we would have called tactical adjustments?
And that was my question.
That is really hard, and not every target date team does that, because guess what? You can be right and you can be wrong.
Absolutely. And that's actually, I wanted to get your insight on that, because this is the kind of information that wouldn't show up. That doesn't show up in the media. Not in terms of how frequently would you have done this? The tactical.
Several times a month. Very active. JP Morgan has again, haven't been there for 3 years. At the time I left, and to the best of my knowledge, still has a very active tactical asset allocation process. But again, one of the major inputs into that process, and again, we're getting super geeky, is how much risk are you prepared to take when you go off your long-term plan? And I mean, you can think about it like probably a good analogy. I'm making this up on the fly, so bear with me. But I think a reasonable analogy is, when you're driving you're going on a cross-country trip, you're on the freeway, and you see one of the signs that says gas, and you're like, okay, is this gas 5 miles off the freeway, 15 miles off the freeway, 0.2 miles off the freeway? Sometimes they don't tell you. Right. So sometimes you get off the highway looking for gas. This happens a lot in South Jersey off of 295, and you're going for 4 miles. And you're just like, if I'd known that, I would have waited till the next rest stop. Like, this is not in my plan. Right. So just like that unknown, right, depending on how volatile asset classes are, you can say, oh, I'm going to take a small decision and overweight or underweight my normal allocation, right? To overweight means to add more, underweight to have less. Let's say stock bond.
Sure.
5% doesn't sound like much. But in a market where 5%, like the equity market,
oh, absolutely,
that could have huge implications on your portfolio. So most robust tactical processes talk about something called a risk budget, which is essentially how much money am I
see.
prepared to lose if I make a whole bunch of mistakes. And you only make, and that is very tightly connected to how much volatility is in the markets then. So how much is the market moving around? How quickly could I lose this money if I'm totally wrong on everything?
That's fascinating that, it's the first time I'd never, of course, the public doesn't know to ask, right? And then also that's not on a piece of paper, right? In other words,
it actually, some of those things are buried in mutual fund prospectuses if you care to go deep. They're there, but like
how many times I'm sure you've dealt with all the disclosures that need to have to go on in those prospectuses. So it's interesting to me, just as a ballpark, do you think that you and your counterparts also have this leash, if you will, on tactical allocation adjustments, and how big?
Again, by prospectus, most portfolio managers who manage asset allocation funds, right, that have stocks and bonds, actually have a fairly wide range of permission. Most people stay well within that, but that's kind of like, if everything goes to hell in a handbasket, we reserve the right to, right? And so that almost is never used, but I'd say, and then there's just the practical, right? If
for
you're running, $125 billion in funds, you want to be rebalancing. You can't do that every day, and you can't wait too long to do it, because then you're moving billions and billions and billions of dollars around. So there's also just how much, we call it drift, away from that. Let's say you want 60 in stocks and 40 in bonds to keep it simple. If the stock market goes up 10% and the bond market doesn't move at all, right, suddenly you're way off on your asset allocation because your stocks have gone up 10%. You suddenly have 66% in equity.
Absolutely. Yes.
So, okay, I've got to rebalance. So some of that rebalancing actually is harvesting gains and trimming losses, right? So you're buying high, you're buying low and selling high, right? If it's gone up to 66%, you're selling, you go back down to 60. You buy some fixed income, which hasn't gone up at all. And ideally you keep doing that. And you're actually adding tactical asset allocation value that way too. So everybody does some of that, right? Because you can't not do that.
No, you can't.
Just the way you run these very large, anybody has to deal with that. So I'd say having a formal process that is deliberately trying to add value, I'd say it's the minority of target date funds. And again, I would say to anybody listening, your HR department, your benefits committee, your plan sponsor, right? The people at your company who are acting as fiduciaries, right? Who are legally obligated to act in your best interest, and their investment consultants who are helping them pick investments are looking at all of this and understanding all of this and deciding if they believe that that manager can do it credibly, question number one. And then question number two, are they willing to pay for it because it costs a little more money, right? Because it's an additional part of the investment process. So they'll make those decisions and decide for you. You don't have to worry about that. But it's easy to get wrong, and it's easy to get wrong a lot.
Sure. And so you've got some bounds, like you said, you had thought in your tactical, when you rebalanced on for a tactical basis, you had some, like you said, a risk budget in mind anyway, whether it's formal or written down or agreed upon.
It's written down and formally tracked by the investment oversight committee. You betcha. Which is part of the process, right? You want to hire somebody who has a rigorous process that they follow, and they can do the math afterwards and say, yep, that decision worked, that one didn't, this is how much, so you don't make mistakes. Or unintended, sometimes you get, obviously everybody gets things wrong, but you don't want unintended things happening that you didn't understand.
Right. That's a very nice way of putting it. Just a couple more, because as I figured, we would get started and I'd have so many questions and we could talk for hours. But in the interest of not doing that, if I took a look last year and this year, that what I actually see, I looked this morning actually in 2040 targeted date funds amongst not JP Morgan, but other ones that were as bigger, the names, that household names, the biggest names. And what you see in there is 80-20
Yep.
for 2040.
Mhm.
But if we look at CalSTRS, I mean, in other words, the defined benefit groups, if you will, the biggest ones, that theirs look like 60-40, if you will, which is a notable difference in
Mhm.
allocation. These are not close really. And in Anne's world, you're drilling down to percent, which are going to be single digits for sure. CalPERS, of course, has the access to the private markets across the board as the JP Morgan. They may even have a better call in certain instances, right? Because
they're very respected investors for sure.
right,
Yes.
they call all the banks answer for sure.
Yep.
So they've got access. What accounts for the difference?
Oh boy. So a lot of things. The biggest difference between defined benefit investing and defined contribution investing, right, is when you're a defined benefit investor, you are on the hook for making up any shortfalls. Now, I don't know exactly how the California plans are structured. So actually, let's take public plans off the table because that's a little different. But if you're a company,
Okay.
right,
Okay, yeah, sure.
and you have a pension shortfall, the company has to write a check. So that skews them out of the gate to try to think about a slightly different mix of risk and return.
That's interesting.
Okay. The second thing about a pension is that the company is on the hook to make a certain series of fixed payments in the future today to current retirees and future retirees.
Sure.
They're always paying money out. Almost every DB plan now is paying some money out.
Sure.
So they're already in what you could call retirement, really. And they can look at their base of population and know how long that money has to last for. So they're just in a really different part of their life cycle than a 25-year-old person would be, or even a 50-year-old person would be if they're in the 2040 fund, right? 45-year-old. So that DB plan might have to last for 20 years, but a whole bunch of people in there are going to stop needing their payouts, right? They're no longer they're going to die, and they won't be getting those payouts anymore. So they're in a really different mathematical place because this is basically a pool of capital that has to sustain. And they've probably, with their actuaries, mapped out every single individual person in that plan and have calculated life expectancy for everybody in that plan. And they're watching that stuff like a hawk, right? So that they're all over that. That's a really different thing than, let's say, 2040 would be, call it 45 years old today, right? Ish. And that 45-year-old, right, still has another 20 years before they're probably going to start taking systematic withdrawals out of that portfolio. The thing that's so difficult about defined contribution investing, and that's one of the reasons why, I personally think it's so important to think about managing the downside as well as trying to maximize the upside, is every individual only gets one shot.
Right.
And your success as a retiree will depend on how much you save and what the markets do. And you can control how much you save. You can't control what the markets do. And so, if you're lucky and, you had a lot of money let's say you are retiring now, or, at the end of the last bull market, like, you were really lucky. Because, I know people who retired in 2008 didn't feel lucky because they're like, oh my gosh, the market's down, but they benefited from this huge bull market.
Right.
So they got all those returns when their balances were the largest for so long. And if you didn't panic sell in 2011, you were right back where you were, right? So, the markets will go down, they'll come back up, but the bulk of their assets were in these really high returns compared to somebody who was in their 50s and 60s and the 70s, right? Where you frankly didn't have very good returns, right? So that's just luck. So but that defined benefit pool, right, is kind of almost a perpetual machine, although eventually, let's call it another 30 or 40 years, presumably everybody who's currently entitled, very few people still have an active defined benefit plan. So many companies will stop having them. public employers may continue, but that's almost a perpetual machine, right? So they're a very different place in their cycle of investing. And as you pointed out, they do have access to some things that are going to have significantly higher returns in the public markets, probably 2 to 3% higher in the private market. So that is also allowing them to take less risk because they know they get those higher returns. Any defined benefit investor is thinking, how much risk am I spending for the return I'm getting? And it's never just about the return. It's also always about the risk.
Last thing is that their access into these different asset classes, as well as the JP Morgans of the world. You would have had the call to get access, like you said, more is better in terms of different levels, right? Everyday investor cannot buy emerging markets debt, not reasonably. And as we both know, you and I specifically, right, bond fund is not the same thing as buying a bond.
Correct.
Right. So as a result, there are a ton of different, inputs there. But now inside of these are going to be some illiquids of some sort. We have had a regional banking issue, to call it mildly. And of course, in your old location, JP Morgan would have this issue to some degree, but it is so big that it candidly doesn't matter. But to small regional bank, right, they've got a held to maturity portfolio, which doesn't look great, to put it mildly, right? Because they've got loans out to the strip mall in 3 miles away. And now that's been packaged into private equity and other illiquids, and now sit as allocations into the parts where you were just mentioning, you get this extra return from on a portfolio basis. Does Anne have any concerns about this kind of matter? This is a fairly systematic one, right? I mean, in other words, a bank went over under this. I'm talking about tightening liquidity and the fact that we have sat on in this held to maturity portfolio, which affects the liquidity, affects the mark to market, affects the valuations, et cetera, of that entire slice, of which reliable outperformance kickers, if you will, have been provided, no question.
So I think, it's not something I've spent a lot of time researching at that individual level. So I guess my thoughts are, it, as an investor, you really want diversification, right? And if you are buying illiquid loans, which these are, right, you really want not to just have real estate loans, because guess what? That's really undiversified, right? So it's number one, if you're buying illiquid loans and you've got a broad mix of the economy, yeah, real estate's not doing so well right now. But there's also this other thing. If the bank loan is directly held by the bank and they can renegotiate, I think it's called delay and pray. What's that phrase? Right? Where and guess what? It'll either recover or it'll just kind of get defeased and you write it down. But if it's if it's 1/20th or 1/50th or 1/100th or 1/1000th of your portfolio and you write it down, that's why they call it high yield, right? So I guess part of it is high yield and illiquid bonds, you assume a slightly higher level of default than normal, right? And that's why that's where the returns come from, right? You get more return for it because it's riskier. And so I guess I don't want to say some of this is shocking and horrible. I think when you look at specific banks that went under, I don't understand how those investment committees, like, what
out in that spot.
What, like, why was this a good idea? But they weren't even buying super crazy stuff. They just had liquidity, they just had a maturity problem, is what I read in the papers, right? And it's been a while since I dug into it. That was last March, which feels like how many dog years ago is that? But
for sure, right?
But I think if you're considering buying something that has illiquid assets in it, diversification is really important. And I would say having things that have concentrated exposure to real estate debt right now are probably on the riskier side of things, for those precise reasons, right? There's just trouble with offices and retail right now. Again, even in a real estate portfolio, you've got multifamily, you've got warehouse, you've got home care, you've got hospitals, right? You've got many kinds of real estate. And so a well-run run real estate portfolio, say that 5 times fast, should have diversification inside of it. And ideally people who've picked good credits and understood what they were buying. But I think that's a well noted voice of caution when you look at some of these things. And you know, the reason private markets have higher returns is they are riskier, in addition to being illiquid. So some of you get paid a premium because you can't get your money back.
Yeah, I think that what we've seen crazily, right, is that I think I want to call it, it's offshore, it's like UK, but some of the units with Blackstone real estate, they have gates now on mutual funds that are involved in real estate. So it caused a bit, I certainly raised my eyebrows at it.
One of the
illegal,
yeah, and one of the things I think is really important to remember, again, just talking about target date funds, is, you know, the target date funds that I was responsible for did have illiquid investments in it. But one of the things we spent a lot of time doing was scenario testing. So what if a gate happens at that underlying fund level, right? At the real estate fund level, at the private credit fund level. What happens if we need to give money back to somebody at the target date fund level? So what happens? How much? We can't sell that thing inside of our target date fund. So let's say we sell, we have to liquidate everything else, and the amount of that thing that we own goes up, relatively speaking, right? So one of the things that our team did going into the financial crisis was we were getting worried about real estate like in 2005, right? So we started underweighting real estate and not buying it, so that we naturally, as our funds grew, we naturally let the amount we had go down so that we didn't have that problem, basically. So hopefully if you're buying an asset allocation portfolio like a target date fund, and there are some of those illiquid investments inside of it, the target date fund can always manage its liquidity because they've got 90% of the portfolio or more that they can use to sell. If you're thinking about buying a fund that is investing in illiquid assets, you really need to understand the liquidity capacity underneath and under what circumstances those things may be gated. And you should never buy something in an illiquid asset class if you think you might need the money back in a hurry, because you can never count on that happening. You just have to accept that risk. And that's part of why you get those great returns.
Absolutely. And I can't thank you enough for joining. I knew I had high expectations, actually. I knew that there would be no question you can't answer, pretty much. And especially be able to, you've had so much experience in speaking to the public that you could translate that to people from all different types of backgrounds. Expectations met and exceeded.
Well, thank you. Thank you.
Tell us, I know we've got strict instructions to not talk too much, but you've got a book coming out next year.
I do. I'm super excited. Called Your Best Financial Life, and it's going to be published by the William Morrow imprint of HarperCollins, coming out in March next year, and really aimed at Gen Zs and millennials to help them get on the path for a secure financial future and to save and invest. So very excited about that. Hopefully
around that time, you'll rejoin us and you can tell us all about the book.
I'd love to. I'd love to.
And thank you so much. It's been my honor to have you.
Oh, Jay, thanks so much. My pleasure.